Today's lecture, this is the first one I'm doing on with the server. It's about liquidity, which is honestly probably the most important concept in trading because it helps us understand why price moves and where it's going and why it will reverse. And the markets aren't random. I'm sure you guys know this. Price is always seeking liquidity, generating liquidity, or taking out liquidity. So that's why we need to know everything about it so that we can have an understanding on why price reverses at one point or why we're trading up to this certain high. So that's what we're going to talk about today. So to understand what liquidity is, we must go over two things, which is buy stops and sell stops, and also limit orders. So buy and sell stops are basically stop losses, and stop losses are when people enter a trade, they have a set take profit and stop loss, which it's like a trigger on when people exit trades. So an easy way to think about it is just money entering and exiting the market. When people enter a trade, money enters the market. And when people get stopped out, money leaves. And it's the same thing for limit orders. Limit orders are triggers where people get entered in the trade. So, for example, like let's say this high right here, if this point in price gets crossed, then somebody maybe will enter in for longs or shorts or whatever. So it's important to know these because it brings money in and out the market. And what liquidity is a massive amount of buy or sell stops or limit orders at a certain point in price. And it tends to be above prominent highs and lows. So if you guys look at this picture right here, you guys see how I circled out prominent highs, prominent lows, which are just highs and lows that stick out. Like these ones, they don't matter, but these ones you can really notice. And those are the important ones because that's where liquidity is usually resting, at these prominent highs and lows. So I'm going to go on the charts real quick so that I can show some more examples. So it's on any time frame really. If you go like here, you can see these prominent highs and lows. There's always liquidity resting. Right here, right here, right here, right here. I can literally just circle everything I see. Go on to the next slide. Why is it important to know about liquidity? Why is it important to us? Why does it matter? It matters because liquidity is like fuel for price to move. The market either hunts liquidity or price is generating liquidity or sweeping liquidity. So what I mean by like sweeping and generating and hunting liquidity is we'll either trade up towards a draw on liquidity or we'll hit that draw and then reverse and then go seek another draw on liquidity. Or we can be accumulating, which generates these draws on liquidity, as you guys see right here. So it's really like fuel for price movement, and it's important to know this and where liquidity rests because large institutions and big market participants, so like banks and those big traders, they can't enter massive positions at once. They simply just have too much money. Their orders are too large. So they need a large amount of buyers or sellers at specific price points. And in order to find these orders, they'll do it at areas where people commonly place stop loss and take profits. So again, prominent highs and lows. And it matters because this can help us get good executions and catch reversals. And it's really just the foundation of almost every model. It explains to us why price reversed where it reversed. Why did the market spike after hitting this low? Why did my stop loss get hit and then price reversed towards my direction? It's all because of liquidity. So on to the next slide. Now we're going to dive into the actual topics of liquidity and what we can use them for. And the first one is just easy liquidity sweep. So what a liquidity sweep is when you see a prominent high or low, like we mentioned before, where there's a lot of resting orders, when those highs or lows get hit, that triggers all the orders, the limit orders, the buy stops, and the sell stops. So those getting hit either enter a lot of money into the market or exit a lot. And this gives institutions the chance to fill all of their orders at once. As you can see right here in this picture, there's a really good example. So we had this low right here resting. Again, this is a prominent low because it sticks out. And then this low right here, we wick past this one and then price just immediately displaces. And liquidity sweeps are usually the start of a reversal. So like here we're kind of just ranging in this example, but you see after we take out that draw on liquidity, we go bullish. Here's a chart example. So this isn't really the best example, but it'll do. So here we have a prominent high, right? Because again, you zoom out of the chart and you can see it. That's what really like taught me liquidity very well. It's just looking at zooming out of the charts and seeing, okay, what sticks out. Like you see these highs and lows in like this move, and none of this really matters. But it's these highs and lows that make the difference. That's where liquidity rests. So right here, as you see, we had this high and then we trade up to it. This was actually today's market open. So after we trade up to it, as you can see, we reverse. And then what does price want to do? It wants to seek out other draws on liquidity right here. This is literally happening in real time as we speak. So if you go here, we have a swing low, which is a very prominent low. Move over here, and you see we trade below that low, and then we immediately start moving up. So that is all liquidity sweep is. Basically just looking for prominent highs and lows, and then after they get hit, you can expect price to maybe reject or reverse. All right, so now we got to talk about the different types of liquidity because it's not always the same. There's many different types of draws on liquidity, which I'll explain what that is in a sec. But first, there's buy side versus sell side liquidity. And this is a pretty simple concept. It's just highs and lows that are towards one direction. So buy side liquidity is liquidity that rests above highs. So if you go onto your chart, just look at the highs, and that's where buy side liquidity is resting. And then sell side liquidity, which is in this picture, is just, again, liquidity resting below lows instead. So it's very simple. Just if you see highs like prominent highs and lows, that's buy side liquidity. If you see prominent lows, then that's sell side liquidity. And now we're gonna move on to different draws on liquidity, which is it might be new to some of you guys. I don't know if you guys know like all of these different draws on liquidity, but all it is a specific high or low that is a strong price point for price to trade to or reject off of. So I like to think of it as a magnet for where price wants to trade to. And once we trade to there, we can expect a reversal. So it's best to always have a draw on liquidity before like entering a trade, because that allows us to get the most out of the trade and take the best trade possible. So for example, if we wanted to take longs, having a draw on liquidity could set our target and could even set our stop loss. Because if we just swept a prominent draw on liquidity, you can put your stop loss right below the low that took that out. And then if you're longing towards a different draw on liquidity, you can get the most out of that trade. So let's go over the different types of draws. The first one, we have high resistance versus low resistance liquidity. So a high resistance high or low is basically when we sweep a previous high or low, and then we can target low resistance liquidity from there or another draw on liquidity. So a good way to look at it is if we take out a previous high or low, we set a new swing high or swing low. And that could be our high resistance liquidity. So like in this picture. And then low resistance liquidity is just failed swing highs and lows. And it happens a lot during, if we're like aggressively displacing down and we just make some like small little highs and lows, that's a really good example. So like right here, if I scaled up a time frame, it would look a little bit better because these are kind of like sort of prominent, but these are all low resistance liquidity because we don't really expect a reversal off any of these. If anything, these ones are high resistance, and yeah, these ones are all low resistance liquidity. Even in this picture right here, this is an example of low resistance liquidity because it is a failed swing high. Because we didn't take out these highs, we failed to take those. So that sets a low resistance liquidity. And then the next draw on liquidity is internal versus external. So internal liquidity, kind of like what we saw in the example before, it's just fair value gaps, accumulation, low resistance liquidity, order blocks, just all those type of things like PD arrays and such. So in this picture, as you can see, we're trending up, but there's nowhere for price to reverse here because we don't make any like prominent highs or lows. We just have fair value gaps, some accumulation, some order blocks, and that makes it internal. And then external liquidity is where our swing highs and swing lows and equal highs and lows rest. So at like the beginning and the end of this move right here, there would probably be like a swing high up here and swing low down there. And that's where our external liquidity is. So an easy way to look at it is look at like a swing low and then a swing high, and then whatever's in between that is just internal liquidity, because we're not making any swing highs or swing lows within this range. But then once we get to these swing highs and swing lows, that's our external liquidity. That's where we can see some type of reaction. And then the next draw on liquidity is equal highs and lows, which I mentioned for external liquidity. And it's just basically just multiple highs and lows that are formed roughly at the same price point. So in this picture, as you can see, we have these three highs right here. These three highs are relatively around the same price point. They're all a little bit lower than each other, but that makes a very strong draw on liquidity because, like we said, these prominent highs and lows have a lot of buy and sell stops and limit orders. So imagine all of these are just stacked together. We have one prominent high. This has its own buy stop, sell stop, limit orders. And then this one also has its own, and then this one also has its own. So it all just makes a big pool of liquidity. And then once we take that out, we can expect a rejection. So it's usually formed during an accumulation, which is just price. It's ranging. It doesn't really have like any objective. It's just trading sideways. That's what an accumulation is. So whenever that happens, it's actually a really good time to look for equal highs or lows, because since we're just ranging, we're moving sideways and generating liquidity. So this is not really that good of an example because we do kind of get like aggressive move down, small move up, and then this is on a higher time frame too. But if we're trading let me go on the charts for this actually. Here's not that good. Okay, here's a pretty good example. So as you see, like here, we're kind of just ranging. I'll draw it out with the blocks. So here we're just ranging. We're not really moving towards any direction. We're just moving sideways. And what we're doing is we're generating liquidity, because I'll circle this out. Again, prominent highs and lows. As you see, a lot are being formed here. I can keep circling them. Just a lot are being formed. But what does that do? That forms a lot of liquidity under and above these. So there's going to be a huge pool of liquidity. And then below here, there's going to be a huge pool of liquidity as well. So as you see right here, we sweep one side of that consolidation, and then we trade way higher. I think I had a picture of this in the slideshow. So that's all that equal highs and equal lows are. They're very good to spot on the chart because it's a very strong kind of like magnet for price to go to and then reject off of. So it's probably one of the best draws to trade. Yeah, so I think this is the final one. We have engineered high and low. And this one I don't see a lot of people talk about, even though it is probably one of the best draws on liquidity. So it's kind of crazy that people don't talk about it, because from what I've like seen, every time I've traded using an engineered high or low, almost every single time it's hit. So what an engineered high or low is, basically, it's when we have a high or low resting above or below the consequent encroachment of a PD array. If you guys don't know, for you guys in the call, a consequent encroachment is the 50% of a PD array. So in this example, we have a fair value gap. This low right here is sort of just resting right under the consequent encroachment. It doesn't quite reach up to it. It's just resting below. And basically what that means is the consequent encroachment of a higher time frame fair value gap is a very strong point in price where you could trade to or reverse off of, as you guys probably know. If you guys, for the YouTube video, that's going to be talked about in another video. But for the people on the call, yeah, so the consequent encroachment is a very strong point in price where we could reject off of. And when there's a low resting right below the consequent encroachment, that just sets a huge place that we could reject off of. There's going to be a lot of orders here, and then plus the PD array being there. It is a super good place to trade to, or a super good place for price to reject off of. And that's why I love using it, because it makes a lot of sense. It should always be resting above or below the 50% of the fair value gap. it should never like tag into it, because if it tags into it, it kind of just like it becomes a little bit of a weaker draw. So just whenever you're looking for it, just make sure it's always below the 50%. But yeah, it should always be right under the 50%. It doesn't have to be fair value gap either. It can be an order block or like a, it could be any other PD array. Just as long as it's like resting below the consequent encroachment of any PD array, then it's fine. And then in this example, you can kind of see we trade up to it, we perfectly wick it, and then we continue downwards. I'm gonna find another example on the charts. All right, so first thing, also another thing I forgot to mention is that whenever you're looking for engineered liquidity, you want to find a high that's preferably resting inside of a higher time frame PD array. So if it's like a 5 minute gap, that it'll still like work, but just not as well. Like it's not as strong of a draw on liquidity. So I'm gonna find an example real quick. Okay, actually here's a good example. All right, so this one's gonna be on the 5 minute. Ideally, we want to have a higher time frame PD array, but I couldn't find an example, so it'll do. All right, so right here, we have this 5 minute gap, and then right here, this is actually a great example because we have relative equal lows, along with them being right above the consequent encroachment of this gap. What could we expect if price reaches down here? Well, we want it to reject, and a very strong rejection. So as you see, we get heavy displacement because this was put here to be taken out later, basically. Notice it's resting right above the consequent encroachment. We trade, we tag into the consequent encroachment. This one is a little weird because we did kind of displace a decent amount below. Like if you're to go on a lower time frame, we did kind of trade far away from this low. But if you stick to the higher time frames, it works fine. So then right here, boom, we reject. And then you could have entered off of a lot of things here. So like this CISD, that could have been your entry, or even this gap right here. There's several entries here. And yeah, that's another example of engineered liquidity. So it's a very powerful draw. Remember, higher time frames work best for it. You preferably don't want to go down to like below the 5 minute. 5 minute can be fine sometimes, but from what I've seen, it doesn't work as well as the higher time frames. Okay, yeah, so there was one more actually. It was just news high and low. Very simple to explain. It's just after we get a news candle. So for example, like CPI, if you go back and look at CPI in like previous day charts, you'll see that after that candle is made, we usually want to trade towards one side of that news. So either the news high or low, and then we trade to the other side. So on news days, whenever we get some type of, big candle, just expect price to take out one side of that candle and then trade towards the other. It's also a very strong draw on liquidity. Usually always, every time there's news, it always happens. I think last time there was CPI, it didn't happen. If I remember, we just kind of displaced very bullish last CPI. But yeah, just that's something to look out for. Every time there's news, just anticipate one side of that candle to get swept, and then the other end of that candle to get traded towards. And that's all for this lecture, actually. Yeah.